Hi everyone, I asked one simple question in the comments section of this channel. Are you waiting for a dip or are you buying every single month? Over 1,000 of you answered, and what I found stopped me cold. Not because the answers were wrong, but because the same 5 mistakes kept showing up. And this was from investors of every age, every income level, every experience level. Each one is quietly costing people thousands of dollars they will never get back. Today I'm walking through every single one. Real numbers, real solutions. A better strategy for each mistake. One that works right now and will still work 10 years from today. This one was built for you. Stay with me. Mistake number 1, selling SCHD to wait for a better re-entry. One investor wrote this word for word. I sold everything at $30.90, waiting to see what happens in the coming days. I respect that, but here's the question that comment never answered. What price actually makes you feel safe enough to buy back in? Here is what really happens. If the price drops further, it feels dangerous. So you wait. If it recovers to where you sold, it feels like you missed nothing. So you wait. If it pushes past your exit price, it feels too expensive. So you wait. The comfortable re-entry almost never arrives. Here is the math. SCHD has grown its annual dividend at over 10% per year across its lifetime. Every quarter on the sidelines, you are not just missing one payment. You are missing every future payment that quarter would have compounded into. A dividend stream growing at 10% doubles roughly every 7 years. Miss enough quarters and you miss entire doubling cycles, permanently. The exit that felt like protection becomes the most expensive decision of your investing career. Mistake number 2, confusing SCHG's past total return with SCHD being a bad investment. Several comments said some version of this. Trash ETF. Just compare total returns before you buy. Fair point. Here are the actual numbers. Over the past 10 years, SCHG delivered an annualized total return of around 17%, compared to SCHD's 12%. That gap is real, and I'm not going to pretend otherwise. But there are 2 things that comparison leaves out. First, past total return does not tell you which fund survives the conditions you personally have to live through. SCHG carries nearly 3 times the price volatility of SCHD. For an investor approaching retirement who cannot absorb a 30 or 40% drop without derailing their income plan, volatility is not a minor footnote. It is the entire story. Second, SCHG's dividend yield sits at around 0.4%. SCHD's sits at around 3.5%. If your goal is income, you can actually spend without selling shares. SCHG was never designed for that job. It is a price appreciation vehicle. SCHD is an income machine. Comparing them on total return alone is like comparing a truck to a sports car on top speed. The question is never which one goes faster. The question is which one fits the life you are actually trying to build. Mistake number 3, the SGOV trap. Parking in short-term treasuries waiting for the perfect entry. One viewer nailed it. You don't earn nothing sitting in cash. You can sit in SGOV, but you need more discipline than 95% of investors have. That viewer is right. SGOV is not a savings account. It currently yields around 3.5% annually. That is real income. Warren Buffett himself has held massive cash positions for extended periods. The strategy is not stupid, but it requires discipline that 95% of investors do not execute correctly in practice. Here is what actually happens. The investor parks in SGOV waiting for SCHD to drop. The market recovers. SCHD climbs. The investor either chases back in at a higher price or stays in SGOV indefinitely while the compounding machine runs for everyone else. The gap between the strategy that works on paper and the execution that works in real life is where most investors leave their wealth permanently behind. Smart use of SGOV as a true emergency fund? Absolutely yes. Using it as a permanent waiting room for a SCHD entry that always feels slightly too risky? That is where the strategy quietly breaks most investors who try it. Mistake number 4, panicking over missing the ex-dividend date. Multiple comments said, dude, you just missed the ex-dividend date. Here is the reframe. SCHD pays every quarter. March, June, September, and December. Missing one date means missing 1 quarter out of 4. The machine keeps running every 90 days regardless. What most investors never realize when a stock goes ex-dividend, the share price typically adjusts downward by roughly the dividend amount. Buying after the X date often means acquiring shares at a slightly lower cost basis and collecting the full next quarterly dividend on every one of those shares. Over a 20-year income strategy, missing one ex-dividend date does not move the needle. What moves the needle is letting that missed date become a reason to delay buying for another month, another quarter, another year. Get on the machine, stay on the machine. Mistake number 5, buying the ETF that dropped less, when you should buy the one that dropped more. One viewer said, you should buy whichever quality ETF is down more. If two ETFs have similar long-term histories, but one is at a deeper discount, that one has a higher yield and better future return potential. That logic is correct. It is the thinking that separates serious investors from everyone else. Here is how to apply it. If SCHD and a comparable dividend ETF, such as DGRO or VYM, have delivered similar long-term returns, but one is at a steeper discount, the discounted fund gives you 3 advantages at once: a higher starting yield, more shares per dollar, and stronger odds of outperformance as price returns to fair value. This is not market timing. You are allocating the same capital toward the same quality at a better price. The exact logic SCHD's own reconstitution uses every March. The fund sells holdings whose rising prices compress their yields and replaces them with quality companies at better valuations. Automatically, without emotion. Every year. You can apply that same discipline across any comparable quality ETFs you hold. Know what you own, know why you own it, buy more when the market hands you a discount. Here is what 1,000 comments proved. Every mistake shares one root cause. Permanent decisions made from temporary feelings. Selling and waiting is a feeling. Chasing total return numbers is a feeling. Parking in SGOV indefinitely is a feeling dressed up as discipline. Panicking over one missed dividend date is a feeling. Defaulting to whatever feels safest instead of running the math is a feeling. The investors who build real wealth with SCHD removed that equation entirely. Fixed amount, fixed date, buy regardless of price, headlines, or what anyone in the comment section is doing. SCHD has delivered around 13% per year since it launched. Through every crisis, every panic, every moment of maximum uncertainty. Not because the market was ever calm, because the fund's rule-based system kept compounding dividends and buying quality while everyone else managed their emotions. Your job is not to manage feelings. Your job is to own shares and collect growing income. Which of these 5 mistakes hit closest to home? Be honest in the comments. I guarantee you're not alone. Smart investing, profitable results. This video is for educational purposes only and is not financial advice. Past performance does not guarantee future results. Please consult a licensed financial professional before making investment decisions.